Hello everyone. Let's begin with our new lesson, which is sources of long-term finance. Okay, FM, the theory portion, the theory part. Okay. Now this sources of long-term finance is nothing but what we have done about cost of capital. Okay. The sums and everything which we have solved based on cost of capital, the overall cost of capital, the weighted cost of capital. This is what the chapter talks about. The theory part of this chapter we are going to see today. Okay, now when I have told you all this before also, that whenever we do these chapters, especially this cost of capital, we always do it from company point of view. Okay, now if I am talking about long term finance, I am talking about any finance which I require for my particular project, okay, which is going to be undertaken, and there will be returns earned from that project. Returns earned. So if a company has to undertake any kind of an activity which is going to be a long term in nature, for which they require long time finance, not a finance for 1 and 2 days, okay, just 1-2 days loan or 1-2 months loan, or the loan which is repayable in a year's time. No, they require long term relationship, somebody to support them with the finance for a long term. Okay, it will not be repayable immediately after the business starts working. So for a company, when a project requires to be financed, that project has to earn certain returns. Okay, for that company, it is very important to ascertain the cost of capital that will be incurred for the purpose of comparing that with the returns. Only then they will be able to take a decision whether this project should be taken up or not. Okay, so say for a company XYZ Limited, okay, they are coming up with a project of buying a new plant and machinery. It is going to cost them some 150 crores. Okay, obviously this amount is a huge capital amount. Capital amount means a long-term finance. And with this particular machinery, with this particular plant which they are going to install it and have it in its place, they are going to earn the returns with their operations, and that return is going to be around 20%. Okay, 20% per annum will be the return. This is what they have already ascertained, because they have done the entire study about, and the research and development plan, and the stage is over, and this is the project expense and the cost which they have ascertained. Okay, with the help of that, they have ascertained how much return can this project give us over the period of time. For this, I need to approach my investors and ask them to help me with the finance. But the investors are not going to come free of cost. Investors are going to ask return. So for investors, it is going to be their return. Okay, for investors, it is the return they are going to earn. But for me, company, it is going to be the cost of capital. So say my overall cost of capital is 15%. Okay, and my expected return on the project, okay, the return which I am going to get is 20%. I will be able to take this decision that yes, this project can be gone ahead with. We can invest the amount in this project. Why? Because my cost is going to be obviously less than the returns which I am going to get from this project. So this is the main purpose of understanding why do we need the long-term finance, and whether this long-term finance is going to help us get appropriate returns with the cost attached with this particular finance. Okay, so long-term finance, what could be the purpose of the long-term finance? As I told you, long-term finance, we needed to finance our fixed assets. Just I gave you the example of plant and machinery. Finance permanent part of working capital. Now certain companies say, if I'm in a manufacturing organization, okay, I am manufacturing biscuits. Okay, so for me, when I go and as a consumer, I buy a biscuit of rupees 10, but the investment, the biscuits, selling of the biscuits, making the biscuits, it's the entire operations which is involved, which is working capital. But that is going to be a huge amount. If for that particular 10 rupee packet, There will be an investment required of 100 crores. Okay, only then these many outputs can be generated, because there is a huge amount of investments in the inputs. Okay, so day-to-day operations, which is working capital, also requires a permanent amount of finance, permanent finance nature. Okay, and also to finance my growth and expansion plans if I have, right, growth and expansion. Now, factors which will determine my long-term financial requirement is, the first most important is the nature of business. Okay, now nature of the business means there are certain companies which require very small amount of finance to start up their business and do their work. Okay, so say it is an online marketing company. Okay, it is a software company. The softwares can be even made with a very few amount of cost, where you can do your own investment and start working. But then if I'm talking about a manufacturing organization, I'm talking about those companies which produce like cars or refrigerators, big amount, big huge amount of plant machinery, cost of labor, material, everything is going. So nature of the business, okay, what is the nature, what will be the amount of capital which they will require for a long period of time, that will be determined with the nature of the business. Also, nature of goods produced. Example, cars, heavy consumer items, refrigerators, they require more fixed capital. More fixed capital. Nature of business, say I am into manufacturing of biscuits, so working capital here will be required more. That also has to be financed by long-term finance, long-term source. Uses of technology, okay, in heavy industries, steel industries, okay, these automobile industries, etc., there is a lot amount of capital investment which is needed. So if there is a technology related company, if there is a simple technology, yes, then it can be produced, you can finance it with a short term finance also. But if it is a company which require capital investment which is really large, okay, high, obviously you have to take that also into consideration. So there are three things: nature of the business, nature of the goods which you are producing if you are into manufacturing, and the third is the use of technology. Now when I have ascertained that, okay, I need my long-term finance for this particular purpose, I have to now see the next step, that from where, which should be my source. I have to understand that what should be the source of my finance. Long term, I understood that it is about long term finance need. Okay, I have also ascertained all the details about the project. I know the expected return of the project. Now I will have to know what is going to be my source. I have to understand that. Okay, so for the source, in order to select a source, what will I look at? What will I study? The first most important thing. See the name of the chapter, no? It is what? Sources of long-term finance and cost of capital. So the first important thing before selecting, obviously before selecting the source, I will see the cost of capital. Only then I will come to know whether I can invest in this project or no. So I will have to ascertain whether which capital I can go through. Ownership capital is equity, preference, retained earnings, your reserves. And borrowed capital is debentures and term loans. Okay. So sources of long-term finance is in form of internal and external. Internal is equity share capital, preference share capital, retained earnings, and extension, which is debentures, term loans, any other kind of external finance can also be there. Okay, so cost of capital is nothing but that minimum. Okay, it is the required rate of return which the firm must achieve in order to cover the cost of generating funds in the marketplace. At least your cost of capital should be minimum, at least equal to the return which is going to get generated with the help of whatever project you are going to invest. With your investments, okay, your return on investment has to be At least your cost of capital at least has to cover your return on investment. Okay, it is the benchmark which the new project has to meet. It is a benchmark. So basically, if I'm seeing from the investor point of view, it is the minimum required rate of return. Okay, minimum required rate of earnings, or the cutoff rate of capital expenditure. Right. Also, cost of capital is the rate of return the firm requires from the investments in order to increase the value of the firm in the marketplace. Okay, so whatever is my long-term finance, I'm going to invest. Investment is going to give me return. That return I have to use to pay my cost on the capital which I have taken. So at least my return should be, that much, that where I can cover my cost of capital minimum. Okay. Now, factors determining the firm's cost of capital, it depends. Okay, now there are many factors which are going to influence the cost of capital. Okay, whether it will be high or low. Now, general economic conditions. Now, general economic conditions in India, if you see loans are very expensive. Okay, as compared to, say, you go to Dubai or you go to any other, like you go to USA, loan will be at 2%. Here we have 10%. Very expensive. Obviously, developed countries, the risk of the loan, the risk when you invest is really less. Therefore, the return is also less. See from that point of view. So, 2% is the rate of interest on loans, but whereas in India it is 10%. Developing country. So, your general economic conditions are also the one important factor which will determine the cost of your capital. Okay. Then market conditions. How is the market moving? Okay, whether there is an inflation, whether there is a deflation, whether there is a boom in the market. Okay, whether there is a higher risk involved in the market. The conditions of the market are falling down. So even that can be the one of the factors which will influence your cost of capital. Operating and financing decisions. Now, say if I am an airlines company, my operating cost will be so much. Why? Because I will require so many hangars, so many planes, staff, the ground staff, operating staff, etc. and what not. So my operating cost itself is so high. Operating cost, which is associated with the business. So my business risk is also going to be high. Okay, so business risk and financial decisions, both, and then the financing decisions, obviously, which you are taking. There are two types of risk, right? Business risk and financial risk. So both has to be taken into consideration and both will affect the cost of capital. Financial risk is basically the minimum return on your common stock, on the return which you can provide to your stockholders or to your shareholders. Then amount of financing, how much is the amount you need? Depend on that, there will be a cost incurred. Okay, a cost involved. Say initially your debt will cost you only 6%, but the more and more you keep on taking the debt, okay, we saw yesterday also in our chapter, like the more and more debt you take, the cost of the debt will increase. It will become 10%. Similarly with the equity, similarly with the preference. Okay, so amount of financing is also very important factor which will affect your cost of capital. However, there are factors which are controllable, which will help you control your cost, and there are factors which you can really not control. Okay, cost of capital is going to be high or low irrespective. You cannot control those factors. But there are certain factors which a company can look into deeply, which will help them reduce their cost of capital. Okay, control. First one is your capital structure policy. Have a proper optimal capital structure which will give you the overall cost of capital should be less. Okay, average it out. Okay, so here see, optimal capital structure is very important to have a control on your cost of capital. Next is your dividend policy. The firm needs to have control over its payout ratio. Every time you are going to get profits, and if you keep distributing that profits, you will not have enough retained earnings to invest later. You know, investors who are long term investors, they are least interested in dividend. They are invested in the growth. Okay, so keep your dividend policy in a manner where your payout ratio is again optimal. Okay, the best. The breakpoint of marginal cost of capital schedule can be changed. Okay, for example, what is marginal cost of capital? That additional capital which you need. Okay, basically your marginal capital is nothing but the cost of your, I'll denote it by KO only. KO is nothing but the overall cost of capital, no? Weighted or overall cost of capital. Cost of capital new minus the old cost of capital. That is your marginal cost of capital. Okay. For example, as the payout ratio of the company increases, the break-even point between lower cost internally generated equity and newly issued equity is lowered. Obviously, because you are going on paying out, payout ratio is going to be high. If you are going to pay out dividend high, your retained earnings will reduce. Okay, your internally generated equity amount which is there is going to be low. Then there is investment policy. Now, while making the investment decision, the company is making investment with similar degree of risk. So, we always assume that investment comes with a risk. If a company changes its investment policy relative to its risk, both the cost of debt and cost of equity will change. Okay, if you change your investment decisions and you adjust that along with the risk, obviously when you adjust that with beta, your cost of debt, cost of equity both will change. Therefore, your overall cost of capital can also be controlled. Okay, so there are three things which can help you control your cost of capital: your structure, your dividend policy, and your investment policy. There are two factors which are uncontrollable. Obviously, level of interest rate. Okay, so that is nothing to, that is not in our hands, it's not in companies' hand, it is in the hands of RBI. And overall, for RBI also they cannot do anything because it is in the hands of the Federal Bank of USA. So depending on the increase and decrease which happened there, it is going to happen here. And tax rates of countries, okay, that will also is not going to be a controllable factor which can reduce your cost of capital more. Now, measurement of cost of capital is all that what we have done in our problems. Okay, so you have to solve the sums and then come back to reading this particular theory. First, A is cost of our debt. Okay, cost of capital is nothing but basically cost on capital. If you will read it like this, you will never forget the formula. It is the formula of any cost of capital will be the cost upon that capital into 100. Okay, so say for debentures, my cost is what? In case of debentures, my cost, my means company. So the cost for company is the interest. Capital will be the value of the debenture per market price or whatever. If you are calculating the cost on face value, then it will be the face value per debenture or market value of the debenture into 100. That will be your cost of debt. But in case of debt, we know that there is a tax benefit which we get. Due to the interest which we pay, our profit reduces. Because our profit reduces, our tax amount also reduces. Therefore, the cost of debt is relatively less than what is given. Okay, so they will give you 10% debentures. That means I have to pay 10% interest rate on my debentures. Okay, face value of the debenture says 100. So I am paying 10 rupees as my interest, which is the cost to the company. But the relative cost of debentures will be less because there is a tax benefit which is attached to this particular amount of interest. So in that case, your cost of debt will be interest 1 minus tax rate. KD means interest. So KD after tax we have to calculate. So it will be KD says 10%, that is the interest rate is 10%, 1 minus tax rate. This we have done in our sums also. So your effective rate will be 6%. Then we have cost of preference share capital. In case of preference share, we pay preference dividend. We pay preference dividend. Again, same thing. Cost upon capital. So we are talking about the price of the preference share. Okay. So preference shares can be, okay, dividend which is paid to the preference shareholders is always after net profit after tax. Only from their preference dividend goes. Right? It is appropriation of profit, preference dividend. Right? So preference dividend is always after tax. However, there can be dividend distribution tax which can be there on this preference shares. Okay, now preference shares can be redeemable, and redeemable preference shares has to be calculated in a different manner. For irredeemable preference shares, your annual dividend which you pay, which I just wrote, dividend on your preference shares upon the market price of your preference capital or price. Okay, if not given, then we take the face value. So it is market price of preference share per market price, per share, per stock. And if it is redeemable preference shares, then in that case we take the dividend plus the redemption value minus the sale value. Okay, raised to n, no sorry, divide by n upon redemption value plus sale value. Again, this has to be the average. Okay, the price which we take down, this will be my total cost, no dividend. Also, when I am redeeming, I might be redeeming at a higher value. Okay, so redemption value minus sale value, divide by the number of years of your redemption, 5 years, 3 years, 2 years, divide by the average price. How will I get my average price? My redemption value plus my sale value, divide that by 2. Then we have cost of equity share capital. Now in equity share capital, we have done various formulas. Okay, as per the dividend, as per the growth. Okay, so there are various formulas which are there for equity share capital. Now CAPM model is one which is important. Okay, wherein K is nothing but the risk-free rate of return plus beta multiplied by your market premium. Okay, so same thing, cost of capital asset pricing model. Yesterday also we had done this. So it is the same graph again. Okay, wherein on the y-axis there is returns, on the x-axis there is the risk, the beta of the market. So risk-free rate of return says 6%. Okay, or since they have given me 3%, I am taking it 3%. Okay, from there if I want to move to the market, obviously there will be a risk. So say when beta is 1 and there is a market return of 9%. So the market premium will be 9 minus 3, which is 6. This is known as the market premium. Okay. Then cost of retained earnings. Now traditionally it was always argued that okay, any amount which you remove from your own pocket means company's pocket, has no cost. How can it have a cost? You are removing it from your own pocket. This was understood traditionally, okay, but over the years and over the period of time, don't you think that retained earnings is actually the money which the shareholders has foregone? They are saying, okay, don't give us the dividend, keep it with the company. They could have taken that and invested, no, somewhere. So their opportunity of investment is lost. If they would have invested that money in the market, they would have got 18% interest, or they would have got 18% of dividend somewhere, or return in the market at 18%. So retained earnings also have a cost. So when nothing is given, since retained earnings is nothing but it is the belonging of the equity shareholders, we take KR equal to KE. Okay. Retained earnings, earnings which are generated by the firm are distributed among the equity shareholders. This is important. When it is not distributed, it becomes a part of the retained firm, okay, retained earnings of the firm, and it is available for reinvestment within the firm itself. Okay, the firm is not required to pay dividend on the retained earnings. It is not required to pay any dividend on the retained earnings. So it can be argued that the retained earnings have no cost. But the cost of retained earnings must be considered as an opportunity cost of foregone dividends from the point of view of the equity shareholders, because they have foregone their earnings. No, you are going to use their earnings and invest. So obviously it has a cost. So if nothing is given, KE is equal to KR. Okay, then next is your book value weights and market valued weights. When we find cost of capital, we do weighted average cost of capital in order to take the values. Okay, you can find the value based on the book value, or you can find the values based on the market value. We have already solved the sums based on both market value weights as well as book value weights. And marginal cost of capital, I just told you all, it is nothing but it is a cost of additional capital which is being introduced in the capital structure. Okay. Now there is some case studies. You all can read it. It is about true and false. Okay, based on the chapter they are asking you a few questions. This is what you can read it by yourself, and if you have any doubt you can let me know. Okay. So this is it with your sources of long-term finance, which is also cost of capital. Okay. Sources of long-term finance and cost of capital. Alright, thank you everyone.